The landscape of home equity release is shifting beneath our feet. And if you think the schemes we've exposed so far were concerning, what's coming next demands your full attention. The industry is evolving, regulators are scrambling to keep up, and new financial products are quietly being rolled out that could either be lifelines or financial traps. The question is, how do you tell the difference? One thing is certain, lenders are getting more aggressive. With traditional mortgage rates fluctuating and inflation pressuring retirees, the equity release market is becoming a battleground. New hybrid products, promising flexibility and lower costs, are flooding the market. But let's be crystal clear, these aren't necessarily safer. Some now include partial repayment options or drawdown facilities that look appealing on paper, but in reality, they still hinge on compound interest quietly eroding home values over time. Take the case of Richard and Diane. They were assured their plan was more flexible, able to make small repayments to reduce the total cost. What wasn't emphasized? The monthly payments weren't enough to offset the accumulating interest. A decade later, the debt had nearly doubled, despite their efforts. And the contract, it contained stipulations limiting their ability to pay off more without penalties. A cautionary tale, one we're seeing repeated far too often. So, where does regulation stand? The Financial Conduct Authority, FCA, is reviewing equity release advice standards, but let's not assume that means full protection. Even with oversight, loopholes exist. The industry's response? More marketing, more rebranding, more equity unlock schemes disguised as innovative solutions. Some new plans now come with inheritance protection, allowing a percentage of the home's value to be preserved for heirs. But the fine print? It reduces the upfront loan amount while still carrying compounding interest. The trade-off is rarely in favor of the homeowner. What's next on the horizon? Watch for retirement interest-only mortgages, RIOs, to be pushed as an alternative. Unlike traditional equity release, these require borrowers to pay interest monthly, preventing debt escalation. On the surface, it sounds responsible, except the moment someone can't keep up, repossession becomes a real threat. And for those already deep into equity release, new financial engineering tricks, like equity release refinancing, will be sold as an escape. Spoiler alert, refinancing can mean resetting compounding debt at a higher rate. So how do you navigate this changing landscape? The first step, scrutinize every detail. If an advisor downplays long-term costs, that's a red flag. If a lender emphasizes more flexible options, demand clarity on interest structures. And if you're already locked in, explore independent financial advice, not from lenders, but from truly unaffiliated experts who can break down the real costs. This isn't just about financial security, it's about control. Your home is your biggest asset, and the last thing you want is to sign away your future without knowing all the risks. Stay informed, stay skeptical, and most importantly, stay in charge of your financial destiny. If this helped you see the bigger picture, you won't want to miss what we're uncovering next. The truth about home finance is deeper than most realize. Click through and keep watching.